So today I was looking for some dividend stocks to add to my portfolio and came across this company called China Mobile, which is listed on the Hong Kong Stock Exchange. As of filming this video, China Mobile is currently trading at Hong Kong dollars $74.30, which gives you a trailing dividend yield of 6.5%. As for the attractive dividend yield, is China Mobile a good investment to add into your portfolio? Well, let's analyze the company together. Before looking at financial results, let's consider what China Mobile is all about. Put simply, China Mobile operates in the telecommunications and information technology sectors. It's one of the three main telecommunication service providers in China, with the other two being China Telecom and China Unicom. Thus, China Mobile provides a range of mobile and internet services ranging from voice, SMS, MMS, wireless data, and wired broadband connection. Besides traditional telecommunication services, China Mobile also provides information technology services relating to cloud computing, smart home devices, and IoT, just to name a few. As of FY 2023, a breakdown of China Mobile's revenue segments will be as such. Voice services contributed 7.2% of revenue, SMS and MMS services contributed 3.1%, wireless data traffic services contributed 39.1%, wireline broadband services contributed 11.8%, applications and information services contributed 22%, other miscellaneous services contributed 2.5%, and finally sales of telecommunication products and others contributed the remaining 14.4%. In terms of shareholder structure, around 69.8% of China Mobile shares are held by China Mobile Communications Group Co Limited, which is a state-owned enterprise. The remaining 30.2% of shares are held by public investors. Now that we roughly know what China Mobile is all about, let's examine its financial performance over the past 5 years. China Mobile's total revenue, EBITDA, and net profit have all increased at a compounded annual growth rate of 8.2%, 9.4%, and 10.5% respectively. In terms of revenue growth for the individual segments, there are some noticeable differences. The growth rate for telephony service segments has been rather tepid over the past 5 years. Revenue from the voice services segment shrank at a 5-year compounded rate of negative 9.6%, while SMS and MMS services and wireless data services only grew at a 5-year compounded annual growth rate of 1.9% and 0.7% respectively. This rather tepid growth of China Mobile's telephony services segments is in stark contrast to the growth of its wired broadband services and information technology services segments. The wireline broadband services segment and applications and information services segment grew at a 5-year compounded annual growth rate of 21.6% and 30.8% respectively. If you zoom out and look at the overall revenue growth of China Mobile's telecommunication and information technology services, it has grown at a rather steady pace of 6.5% over the past 5 years. Looking at the revenue growth of the sea of telecommunication product segment next, it has grown at a considerable compounded annual growth rate of 22% over the past 5 years. However, it should be noted that this segment of China Mobile's business does not generate much underlying gross profit. As of 2023, the gross profit margin for the sea of product segment is only at a meager 2%. Nonetheless, from an overall growth perspective, China Mobile performed quite well over the past 5 years, with growth in both its top and bottom lines. However, investors should note that despite its rather healthy growth, underlying margins actually declined over the past 5 years. China Mobile's EBITDA and net profit margin fell from 37.4% and 16% respectively in 2018 to 33.8% and 13.1% in 2023. This decrease in margins is mainly due to the rise in operating expenses, excluding depreciation and amortization. Operating expenses excluding depreciation and amortization have risen at a compounded rate of 9.7% over the past 5 years. A bulk of the increase in expenses is due to both network operation and support expenses and employee-related expenses. Both these expenses have risen at a compounded rate of 7.7% and 11.3% respectively over the past 5 years. And as of 2023, made up 40.3% and 21.6% of total operating expenses excluding depreciation and amortization. The rise in these two expenses is to be expected, given the need for China Mobile to maintain and build out network capabilities and coverage for a host of China's networking needs, ranging from 5G wireless networks to wired broadband connection and cloud computing. With this demand for networking and interconnectivity, I expect operating expenses to continue increasing over the next few years. Thus, investors should definitely monitor if this results in continued decline margins and how much of a decline it would be. Moving on to financial health next, China Mobile is in a rather healthy shape. Total assets against liabilities was at a ratio of 3.08. China Mobile also does not have any interest-bearing debt on its balance sheet, while China Mobile's current ratio of 0.89 might spook some investors. I feel there's not much to worry about if we zoom in and look into the relevant components of China Mobile's current liabilities. If we remove both contract liabilities and receipts in advance from China Mobile's current liabilities of 2023, the value would drop to RMB 413.3 billion instead. At this value, it will easily be covered by the current asset value of RMB 486.1 billion after deducting the value of inventories. Now, the reason for excluding contract liabilities and receipts in advance is mainly because they will either be recognized as operating revenue or refundable funds received from customers in advance of services provided, meaning that such funds do not need to be covered by existing cash or current assets on China Mobile's balance sheet. In addition to being able to account for its payables, China Mobile's return on equity is at 9.8%, which is higher than both China Telecom and China Unicom. However, it should note that explain to its margins, China Mobile's return on equity has also declined over the past 5 years. With regards to China Mobile's underlying book value, it has grown at a 5-year compounded annual growth rate of 5.1%. Moving on to cash flow next, China Mobile has reported positive free cash flow over the past 6 years and has also grown it at a compounded annual growth rate of 47.1%. In terms of dividend payout, it's also a sustainable percentage of 77.6% in 2023 and has been sustainable in 4 of the past 6 years. Dividends paid out to investors in Hong Kong dollars have also grown at a 5-year compounded annual growth rate of 14.1%. With expected CapEx in 2024 to be slightly lower than 2023, there is room for China Mobile to sustainably increase the dividends paid out for 2024. All things considered, I think China Mobile is doing pretty well financially, and the only blemishes is the declining margins and ROE over the past 5 years. To determine if China Mobile can continue its growth and hopefully increase its margins and ROE, let's take a look at its future growth prospects. For this, I think it's useful for investors to consider based on the 3 main business segments of China Mobile, namely the telephoning services segment, wired internet connection segment, and finally information technology services segment. Let's start with the telephoning services segment first. Growth for this segment will mainly stem from the adoption of 5G mobile packages in China. While China Mobile's total 5G package customer base has grown substantially since 2020, net additional 5G customers have slowed since 2021. Additionally, while average revenue per user per month, or otherwise known as ARPU, has increased in recent years, it has actually decreased over a 5-year period. Also, China Mobile's total mobile customer base has increased at a rather slow pace over the past 5 years, suggesting potential saturation in the mobile market space. The likely factor for this is increased competition when it comes to the pricing of 5G mobile plans, not just from China Telecom and China Unicom, but also from mobile virtual network operators. Another point to consider is whether the everyday individual who's already on a 4G mobile plan will see the need to upgrade and spend more on a 5G mobile plan. Nevertheless, based on the latest statistical report on China's internet development, 5G mobile plan subscribers made up 46.6% of all mobile phone subscribers in 2023 and recorded a positive growth of 15.3% as compared to the previous year. So perhaps there is still room for 5G to make an impact on China Mobile's revenue for its mobile services segment. Though I would think that any growth will rather tepid, as evidenced by the revenue growth of its wireless data traffic services over the past 5 years. While I do not foresee great growth prospects for the mobile services segment, I am more positive on the potential growth of the wireline broadband segment. Over the past 5 years, China Mobile's broadband customer base has increased from 157 million in 2018 to 298 million in 2023, representing a compounded annual growth rate of 17.4%. Also, out of its 298 million broadband customer base in 2023, 264 million were households. Given that China Mobile's gigabyte coverage covers 390 million households, there is still a significant potential customer base for China Mobile to tap into and sell its wired broadband plans too. This could perhaps partially explain why China Mobile's household customer blended ARPU has increased at a higher rate than its overall wireline broadband ARPU. Furthermore, with internet penetration in urban areas and rural areas of China at 83.3% and 66.5% respectively as of 2023, there remains much room for growth for China Mobile's wireline broadband segment for the next 2 to 3 years. Moving on to the last segment of information technology services, this segment is the one that I'm most bullish on in terms of growth prospects. As we all know, AI is a huge growing global industry at the moment. China is also poised or is already currently spending huge amounts on AI investments for the next few years. This is even more prevalent if you consider export restrictions of advanced AI chips and GPUs imposed on China by the United States. All this spending on AI advancement in China will only serve as a boon to China Mobile due to huge demands for cloud computing and high-speed networking solutions. While China Mobile Cloud may not be incumbent players like Alibaba Cloud, Tencent Cloud, or Huawei Cloud in terms of market share, it can use its networking expertise as an edge over the other market players. This could perhaps explain why China Mobile's corporate customer base has increased from 7.18 million in 2018 to 28.37 million in 2023, achieving a compounded annual growth rate of 41%. China Mobile Cloud also brought in revenue of RMB 3.3 billion in 2023, a 65.6% increase from the previous year. Besides tailwinds from AI and cloud computing, China Mobile is also poised to benefit from nascent advancing industries such as autonomous driving and the general IoT and smart industry as a whole. This is evidenced in China Mobile's growing IoT card customer base from 551 million in 2018 to 1.316 billion in 2023, a compounded annual growth rate of 24.3%. Long story short, as China continues to develop and move into a high-tech digital future, the demand and need for high-speed networking and computing solutions should fuel China Mobile's growth for the next few years. While China Mobile's growth prospects are definitely exciting, investors need to be mindful that much of it is restricted and dependent on China's domestic demand and growth. With China Mobile's significant links to the Chinese government, expansion to Western markets is highly unlikely. Over the years, we have also seen implementation of restrictions on the operation of Chinese companies in the United States. China Mobile is not spared as it was delisted together with other Chinese telecom companies from the New York Stock Exchange in 2021. And more recently, was also ordered to cease any offerings of broadband services in the United States. While expansion to the West might prove difficult, there might be opportunities in Middle East, Africa, and Southeast Asian regions. However, any considerable impact on China Mobile's revenue from such expansions would only take years to decades to materialize. Having looked at China Mobile's growth prospects, let's consider evaluation next. At its current market price, China Mobile's price to earnings and price to book ratios are higher than its 5-year average ratios. The trailing 12-month dividend yield of 6.5% is also only slightly higher than the 5-year average dividend yield. Looking at the price chart, we can also see that China Mobile is trading close to its 52-week high price of 77 Hong Kong dollars and 80 cents. All this suggests that China Mobile might be trading at a slightly high valuation currently. While some individuals might argue that valuation considerations based on the past 5-year performance might not be accurate due to the poor performance of Chinese markets in recent years, I still feel that it's valid as we should always consider market forces in our valuations and not just base it purely on fundamentals. Personally, I think any investor looking to invest in Chinese companies should always account for Chinese discount, as movements in the Chinese market are heavily dependent on sentiment and foreign investments. Overall, from a fundamental perspective, China Mobile is a good company to invest in. It's poised to really benefit from current and future demand for telecommunications and networking solutions, be it with regards to AI, cloud computing, or 5G networks. Its latest first quarter 2024 results also showed positive growth in both its top and bottom line and underlying customer base. Furthermore, given that much of China Mobile's revenue is derived from contractual plans with customers, it provides a rather steady revenue stream as such plans can range from 1 year to 3 years. With a sustainable current dividend payout percentage, ample growth avenues, and expected reduction in capex costs for 2024, there could also be an increase in dividends over the next few years. Nevertheless, at its current market price, I feel there is more downside risk than upside potential for China Mobile. Thus, I'll wait for the price to retrace back to the 65 Hong Kong dollar region before looking to add it into my portfolio. At this price, the trailing dividend yield will be around 7.4%. If you expect dividends for 2024 to increase to at least $500 like I do, then the corresponding dividend yield will be a rather attractive 7.7%. At this yield, I think it provides a good risk-to-reward ratio for the investor.